Hello, everyone. We are back. For those of you that watched part one of the Tom Basso interview on his new book, The All-Weather Trader, congrats. Here you are at part two. If you have not watched that video, hit the pause button, go watch that first interview, and then come back. So we're going to start at chapter 12 today, and a lot of what we're going to cover today is what Tom obviously covers in the book, which are, I would call them old wives' tales or old legends that just get people off track. And that's what we're going to do. So Tom is joining us from his summer home in the mountains of Arizona. Tom, welcome to CB3 Live.
Charles, so good to be here. I had a busy couple of days, and this is going to be fun.
Absolutely. It always is when we get together. So as I did in the first interview, I want to quote, use your quotes and then have you further explain them so to enlighten people. This is from page 155. We're starting in chapter 12. I'm running an extremely diversified multi-strategy, all-weather approach for our retirement accounts. I was not born with a knowledge of how to trade, how to size my positions, how to program computers, or how to change my mental status. So many people think that being a trader is a gift, like a natural athlete or something. I contend, and you clearly contend, that these things can be taught. Tell us why you came to that deduction.
Well, if you think of a new baby, which I was way back some 70 years ago, I had no idea how to do any of this. And I think there's different paths for how you're going to try to get to the knowledge. And in today's world of internet and podcasts and, your show and everything else, there's lots of information out there that people can listen to and read and watch. That back when I started in the early 70s of this stuff, aside from having a good knowledge of computer programming and math, being a chemical engineer by degree, I hadn't even traded a stock. I mean, I'd bought a mutual fund, and that's, like once a week I'd stick my $10 from the paper route in there, but there wasn't a whole lot of knowledge to be had doing that. And so as I came out of school and with an engineering background, it's sort of like, okay, what's the problem to be solved? Where's the data that I need to look at, and how do I analyze that data? And I got into the mentality of trying to get better quickly. And thank goodness for my math and engineering background, because that helped me computerize some things, helped me when computers were available, which was only about 1980. So the first few years, I ruined my eyes with a calculator and pieces of paper. I have to say that I would say to anybody that having the wealth of information in today's world that you offer, and everybody, there's lots of different places you can get information these days. I'd have to say it's almost switched the opposite way. I didn't have any information. I had to figure it out myself for the most part. And nowadays there's so much, you could probably become overwhelmed and confused by it all.
We need a filter today.
You almost do, a filter, and you need to, I think you need to take a serious look at what you're trying to achieve. And I did that in the early years. Being an engineer, I was trying to achieve simplicity and straightforward process engineering with my trading. So I knew when I read something or heard something or talked to someone about something, I knew whether that fit what I was looking for or not, and I discarded what was not, and then I glommed onto what seemed to fit me. So one by little, piece by piece, I built this massive, extreme diversification, programs doing things, broker connections that would work for me. There's lots of other broker connections that would not work for me, and I can articulate why, but I think what you got to do is keep analyzing. And even today, I'm still doing it. I'm still trying to think of my 10th trading strategy and what kind of markets would I like to add if I have the opportunity to do so and have the time to look it through. And so I think that that is kind of the process, and you just get better at it if you're working at it. If you're going to be lazy and just hand it off to some financial planner someplace, and just say, okay, I don't want to learn any of this stuff, it's boring, I don't want, well, then you're not going to get better at it.
Well, you're not. You're going to have to accept the results that they give you and become anxious, and there's nothing you can do to control it because it's in their control. So, which kind of leads to the next point in your book. So you list 4 important items here. Take a personal inventory, write a description of your future trading business, not trading futures, but your future trading business, as if you were going to create a business plan. You and I both know lots and lots of people that just started to trade because the barrier to entry, as what Warren Buffett would call it, it's a low moat. You just need a phone and a few dollars in an account, and all of a sudden you're a futures trader or stock trader.
Stock trader, whenever, yeah. And now
Right.
you can buy fractional shares down to less than 1 share even. So
Exactly.
there's no excuse. Everybody could be a trader with $5 in their account, I guess.
But that doesn't mean that you shouldn't have a business plan. That's a double negative. It means you even more so. The lower the moat, I think the more important the business plan is, because you're going to have lots of competition, including psychological competition, saying, you loser, you shouldn't be doing this. How did you, come to that conclusion?
Well, a lot of it's my engineering background, so I viewed the trading business as sort of a chemical factory with chemicals coming in and chemicals being processed and chemicals being shipped out. And then trading business, you're bringing in data and you're processing that and making trading decisions and making decisions about your position sizes and your diversification and different strategies and all that. And then you're shipping out orders. Isn't that kind of the same thing? So I viewed it in those terms, and that became my business plan, sort of, in that everything I had to glom onto and to work into and to put a piece in place that wasn't there, every one of those was to try to get that process engineering approach to trading to work and to be as efficient as I could make it. And efficient means not just my time, but it's also my it could be my the amount of time I spent. It could be the amount of errors I make. When I first started trading, I made errors. I'm a human being. A computer takes a piece of data, processes it the same way every time, sends the same order that they would always send based on that data. There's zero potential for error there as long as the data is good. So then you start realizing, well, the data is not necessarily perfect. So then you do more programs to check your data, and
Right.
you always trying to achieve perfection and never attaining it. And that's kind of it's like trying to shoot 54 in golf or something. You can keep trying to do it, you don't ever get there, but you get better at it.
Right, exactly. It gives you something to aim at. I mean, surely you noticed, of course you did, that Warren Buffett, 92, Charlie Munger, 99, just had their annual Berkshire conference. And even he is up there saying, both of them, we're still getting better at what we do. At 92 and 99, I just find it staggering. 30,000 people there, and at least 18 to 20 questions they each answered, some with some pretty good significance there. So I think that's got to be one of the secrets to succeeding, is just always looking forward to the next idea. So this all-weather trader, in your book, next in your book and later in that chapter, you mentioned 3 or 4 different people. They were all hypothetical. But one of them was Jen, and she had this idea about how to trade. And, so you ask in your book, was her approach all weather? Well, yes, it deals with up and down markets. Was it doable? Yes, she felt she would have the time each day. Was it tax efficient inside her IRA? Yes, there would be no tax consequences. So when she stepped through all of those, then that gets her to being an all-weather trader. What is the essence? Is it, because the reason I'm asking this is because if you're not able or not comfortable trading futures, you can still be an all-weather trader as long as your strategy handles up and down markets. Could you elaborate on that?
I would add sideways markets too. And you got up, down, sideways. And my read on history is that sideways accounts to more than half of the time you spend in sideways. Last couple months, the stock market's been just kind of sideways. I don't know about you, but it seems boring to me. There's a few
no question.
There's a few pockets of excitement around a Fed announcement or something, but for the most part, it seems like summer vacation has started or something. But if you're spending more than half of the time in sideways, and you have a strategy that involves needing a big trend to make a lot of money, or pyramiding or something like that, your trades, you're going to struggle in a sideways market. So you got to have strategy to deal with a sideways. Maybe your strategy is if it looks like a sideways, you just do nothing and you go take a vacation. That could be a possibility. I'm not saying that couldn't be. But certainly down markets, how many people after COVID, these young 20-somethings, got their stimulus check and opened their brand new stock trading account, and then they caught the upswing after the COVID crash, and they became, their portfolio all of a sudden is $50,000 or $100,000, and they have no clue what they're doing, and they've only done the upside. They don't know anything about bear markets. They have never lived through one.
Correct.
And so they're not all weather because they're lopsided. They're dealing with the, say, 30 to 40% of the time that the stock market spends in up periods. They're forgetting about the 10% and severely dangerous down periods, and they're not dealing with the impatience that they're going to suffer mentally as they spend 60% of their time or 2/3 of their time or whatever in sideways periods.
Right. It's interesting that you mentioned that had they invested in February of 2020, they would have gotten a real quick dose of a 38% drop. But most of them, as you point out, did not get their stimulus checks till April, and all of a sudden they're geniuses. You talk about that later in the book, and we'll get to that never mistake you being a genius for being lucky.
Yeah, exactly.
For sure. So when we measure success in portfolios, there are all kinds of ratios, Sharpe ratios, very popular, Sortino, but you have come up with a new ratio, and I want to read from your book here, and this is page 170. Working for clients and managing my own money have taught me a lot about how the equity curve going up or down can cause the human element to modify or mess up the investing process. That was a nice way to phrase it, by the way. It always amazes me to see those flashy track records out there with a 50% drawdown that show excellent long-term compound average growth rate, CAGR, for those of you not familiar with that. And they're being sold to investors. There is no way that any typical human being that we know on the planet will stick around for that long-term record when they see their portfolio down 50%. Most can't even make it through 15 to 20%. So maximizing return to risk ratio is the ETR comfort ratio. This is totally new to me. Can you talk about the amount of comfort divided by the amount of discomfort and how you quantify that as an accurate risk measurement for a portfolio's volatility?
Yeah, when I started thinking through, everybody, as I was a money manager, certainly, but still in discussions on Twitter I'll have with people or whatever that, they throw out Sharpe ratios and Sortinos, and I'm a mathematician and engineer, so I'm looking at, okay, how are those things calculated? So standard Sharpe is the obvious one. They take the annual average returns and divide it by the standard deviation of the volatility of the investment. And you sit there and think about it, and as a money manager, if I had like a 50 or 100% positive gain, I would be a hero. The Sharpe ratio would say I'm being too risky and my return to risk ratio sucks. And I'm thinking, I've never had a client leave me after producing 100% return or something.
Yeah, exactly.
It doesn't make any sense to me mathematically. It's just stupid. With all due respect to Nobel-winning Mr. Sharpe, Sortino at least concentrates on the negative volatility and says the positive volatility is okay. All right, that's a step in the right direction. However, volatility doesn't equate to risk, the risk of losing hard-earned dollars. That's a completely different animal altogether. And I find that volatility does screw people around with mentally, but the actual loss of dollars is far more impactful. That's the number one. So then you get into MAR ratios, where you take the average returns and you divide it by the maximum drawdown of the equity curve. Another step in the right direction, but that's a one-time event that might have happened 10 years ago and is never coming around again because
Exactly.
you
Black
modification
swan.
strategy or whatever. So I think, all right, well, what do clients and what do I as a money manager, what for me as a trader for my own money, what do I really view as maximizing my return to risk? And of course, the return side is pretty easy. You're making new highs in your equity curve. You're dividing it or compounding backwards to an annual return rate. And that's pretty easy to figure out. And it's always having to make new highs. So I call those surges. This is where I was, I surge higher. So what I do is every day I measure how much I am above this previous surge high and making new and profitable money. Well, that's got to be a comfortable period for me or for a client.
Sure.
Because you're making new highs. What's wrong with that? Even if it's staying the same for one day, it's not discomfort, it's comfort. So let's add up all these little days. So I go back to integral calculus, and a math professor once said, integral calculus is really a way of mathematically adding up a lot of small pieces. It'd be like trying to create the volume of a lake by measuring all the little small pieces of this ragged shoreline and getting various depths and then accumulating them all together, and that would be the integration of all these little pieces into one volume of the lake. And I thought, that's kind of what I want to do here. I want to aggregate all these different comfort periods. But then you're thinking, well, now I got to have discomfort, because that's when people leave. That's when I get nervous. That's, I'm retired. I don't want to go back to work. So I want to protect my capital, watch my risk. So how do I do that? Well, how about we do the opposite? A 5% drawdown, everybody can handle it, no big deal. So set a threshold below which you start accumulating all those days where the drawdown and the day is keeping you in that drawdown, either for a long period of time, which is not good, that's going to be discomfort, or a severe down like in COVID crash, where that could be harmful, and it could be quick and large, and then recover right back like it did in COVID.
Both or October 19th, 1987, same
October
sort of
19th, 20-something% in one day. So you have periods of discomfort that you can aggregate or accumulate, and you have periods of comfort which you could aggregate. Just put the one over the other, and you got a comfort ratio.
Got it.
So and I put ETR on it because everybody knows that I use that in all my pronouncements. So the ETR comfort ratio is a simple comfort days in the comfort zone versus days in the discomfort zone. And I use that internally. It's not a widely followed comfort ratio, but I thought I'd throw it out there and get people talking about it, because I think mathematically it strikes at the heart of exactly what causes people mental anguish in trading or in hiring money managers to trade their portfolio. And if more people kind of looked at what they're doing trading-wise with a nod towards a comfort ratio, I think they'd get closer to doing something that would be comfortable.
Well, I'm going to send this clip to CNBC and Bloomberg to see if they'll consider using it. You guys are seeing graphic 39 on the screen right now, and this shows the amount of time, timed versus buy. So timing the market versus buy and hold, or buy and hope, as we sometimes call it. And you can see it's a significant difference. So let's go to psychological stuff now. We're moving into 13 midway. This is going to take a couple paragraphs, but this is so important. People try to personalize trading, personalize the market. I think you need to personalize your trading strategies, but you must depersonalize how the market is, quote, treating you on any given day. You start here saying First of all, avoid these common mistakes. Markets are apathetic towards investors. They could care less if a single loss wiped out your entire portfolio, nor would they care if your assets are so varied and diversified that an entire economic crash wouldn't put a dent in your portfolio. It doesn't care. Bear and bull markets will continue to exist in a seesaw battle between buyers and sellers, regardless of anything you might do. So take an honest look at your life and what commitments you can make to trading. Believe me, the markets don't care. If your personal life is full of crises or obligations, they will still open and close the same time each day. The markets won't know and don't care if you're having a rough day or a great day. I know that's a lot of reading, but it is so important for people to make the switch, to turn off the emotion when 0830 Central Time hits and the stock market opens. And obviously, it's a different time for futures markets and everything else, because at that point, you have to have your strategy in place.
Yeah. Yeah, and it's 6:30 here in Arizona. It's this time of year. So it gets pretty early. But yeah, one of the things that forced me into a lot of the thinking about contingency planning and making sure you have a backup plan if your internet goes down or your broker goes down or your cell service goes down or just all sorts of things. Electricity goes off. There's so many things that can happen in your life that affect your trading. I realized early on that no matter what happens, no matter who's visiting me, like mom and dad came once and they missed a trade, and it turned out to be one of my potentially best trades of the year. And I don't blame my mom and dad. They were just visiting me, and I blame me for not spending the time I needed. Instead of playing tour guide for my mom and dad, I should have, said, okay, mom and dad, I've got a half an hour work here to do, and then I'll be back to playing tour guide. Right. I live my life a lot more now according to what the market hours are and what I have to do. And thank goodness my wife is totally on board. She understands exactly what times of day I tend to need to try to be open. So if we're planning a tour someplace on a cruise or whatever, she still gives me those little slots where I can do my stuff, and then I recreate the rest of the day.
Yeah, for me it's 4:30 or 1600 hours to 16:30. All the markets everywhere in the U.S. are closed. Forex is quiet, and that's the time to move the daily stops and then go on about your life. So
I find myself doing that, and I think it came from that feeling that, the markets really don't care if you're having a bad day.
No, they sure don't. You talk about starting with too little capital, and I feel like this is a topic this is the elephant in the room. But, someone will say to me, I really want to trade. It's like, okay, you and 942 million other people. Okay, so I want to trade crude oil. It's like, okay, how much are you going to start with? Well, I've got 10 grand. Okay. And I was like, well, do you want to risk 30% of your equity per trade? Because that's what it's going to be. Well, what do you suggest? Well, if you have 10 grand, you can trade shares, because it's real easy to divide shares. You can trade fractional shares, as you mentioned earlier. And if you really want to get into the futures markets, then go into micro Ether. So Ether obviously is a cryptocurrency. And for whatever reason, the micro Ether contract is super, super small. I'm trading like 60 lots. I don't know why they did that. I know, it's just dumb. But so the answer is you have to be properly positioned if you're starting with too little capital. But if you could just elaborate. So you talk about this will always lead to smaller portfolios having more granular, erratic, and less predictable returns. I would think it would be, linear, but the problem is you can't take certain trades with smaller portfolios. That, I think, is what you're referring to.
Exactly. Now, what ends up happening, let's say you're trading 10 different micro futures, and you're covering like micro grains and a micro oil and a micro precious metal or whatever. And you've got this nice little diversified plan. You got your indicators. Everything's going smoothly. But then you're position sizing appropriately, and you're down to one contract sizes in some of these things because you're capital starved. You don't have enough capital to properly keep your risks in check. what's going to happen there is the position sizing algorithms will say you can do 0 contracts on this particular trade because the risk is way too high, the volatility is too high, you can't handle it with your capital. Well, that leads to granularity in that instead of having a very clear picture and a perfectly linear, right on the equity curve type of equity curve, you are going to have most of the equity curve with little hiccups here and there where you miss trades. You'll either have less return or less risk, but it'll be granular, is the term I use to describe that. Right. And that's what I mean by that. You just don't have enough capital. Take the opposite extreme. You have $10 million or $100 million and you're doing it. You're not only going to get every trade, you're going to get it fine-tuned down to the exact number of contracts that you should have. You will be the equity curve. There'll be no granularity whatsoever. It'll be like an HDTV. Perfect.
I had someone ask me this, and this is a good time to ask. So say you buy crude oil at $80, all right, and you buy the June contract, and you did that 3 weeks ago. And we know that crude's lower now, but just stay with me. Now it's at 90, and you're up, substantial amount of money. You're rolling to July because energy doesn't trade HMUZ like the financials. Now, when you roll to that, you have a decision to make. Am I just going to, quote, pretend this is the same trade? Because when I roll, now my risk, instead of being 0.5%, if that's what you're willing to risk, might be 1.25% or 1.5% because the gap is so much higher. It seems to me that when you roll to, and this is obviously only applies to futures, folks, not stocks, not Forex, that you really can't take that next trade because the original crude oil trade in June was so profitable, it's now created a gap, which means your risk literally means you can take 0, unless you just want to tell yourself, no, this is the same trade. But
yeah, here's the way I handle it. And feel free, all you traders out there, to do what works for you. This just seemed to be simple for me. I go ahead and I roll it. But I do it in this following fashion. I take the difference in price between the July and the June, and I create what's called a rollover amount. So the way you do that is you just come to any one day and you say, okay, the June is here and the July is there, and this is the rollover amount, and July is lower than June, so I'm going to go ahead and subtract that from all my indicators. Or July's here and June's here, and I'm going to add it to all my indicators. So the risk on the new indicator is relatively similar to the risk I already was measuring on my June contract. So nothing is really super changed. And then I just, all the indicators take that stepwise change due to the rollover, and then I go forward from there and keep calculating.
And that's data that you just got to track, though, especially, and as I mentioned, for those of you who don't know what I meant by HMUZ, the financial contracts, and there are some others, but mainly the financials. H is the letter for March, and then June, and then September and December. Those are quarterly expirations. I don't know about you, Tom, but I wish all futures were HMUZ. It would make our lives easier.
And I hate rolling, but it is
what it is. What it is. If you want if you want the benefits of it. So, changing topic here. This is something that that you mentioned and that I do, even at my age, and you and I are almost the same age here. But this is a quote from your book on 188. Exercise, for instance, is something you should strongly consider. Finding time to do 20 or 30 minutes of cardio 3 times a week can do wonders for your overall health. At first, you may be sore and tired, but over time, as you remain consistent with it, your body will be healthier and you will reap the rewards of your continued efforts. As I have moved into some day trading strategies, I have felt the stress ratchet, even though I have a very defined plan, and that exercise gives me, I guess, a little more headroom, if you will, in my life. And then when I'm trading just my regular daily and weekly signals, it just gives me an extra bit of energy. What are your thoughts? Obviously, you think it's important. How did you come to that conclusion?
Yeah, I think the same exact thing. I guess what it started out to me back in probably my 30s, started putting on a little extra weight, at a lot of client dinners and, nice bottles of wine and entertaining people and all that. And I had, in my around 34 years old, I considered myself financially independent at that point. In other words, I had enough net worth that given my normal, if I had a modest lifestyle, when it wanted to go into retirement then, I could have. It would have been just a minimal lifestyle, and I just decided I was having too much fun and all that. But I realized right around then that if I wanted to make this be a very, very long-term prospect, I had to think of myself as a little bit more like an athlete. Like, what would an Olympic champion try to be doing here to try to be the best trader he could be? And I realized that there was a lot of aspects to that. There's the mental side. There's all the, getting the position sizing right and the buy-sell engines right and backups and, backup computers and backup internet and backup brokers and all sorts of other backup things. But it also means that I'm going to be potentially put under a lot of tests physically and mentally, and that an Olympic champion would make sure that he was in the perfect shape. And so
Sure.
I decided to start taking on keeping my weight in check, keeping my, when I was playing basketball in college, I was 205 my senior year. I'm 6'3", and I was playing on a championship intramural team that really just blew everybody away. And I am 204 today.
Wow.
I'm 1 pound less. Now, I'm probably not as strong, and I certainly can't run as fast, and I certainly can't jump as high. But, I've tried to stay in decent shape because, number one, you don't have to change your wardrobe. That's a plus. Saves you a lot of money there. And number two, you just feel better. You feel like, if the market's throwing you a wrinkle that goes, against you and all that, you are strong and you feel good and your heart rate's down and you can handle it. You can be Mr. Serenity a little bit. And I think I've carried that forward to today even. I still like working out. We're going to go out and play some golf this afternoon. I'll get out in the fresh air and hit some balls. Just try to keep doing things.
Yep. Stay active. I have in red here, which for me is my biggest highlight color on my Kindle. Remember, one of the benefits of an all-weather approach is the reduction in stress levels, which of course translates into having more time to do the things you really want to do. But you ask a question the next page later. What if bonds lose for 10 years as they did in the 70s and early 80s? You mentioned that these traders that are, getting their refund checks and investing in stocks never have known a bear market. There are plenty of bond traders that haven't either because we had such low interest rates for so long. What if stocks go down 90% like they did during the Great Depression? What if stocks go down 60% as they did in 2008 and don't come back? If you think that these cannot happen again, you are not an all-weather trader. You're not preparing. This is Nissan Taleb black swan, event essentially. So we have to expect that. Let me go here to 2020. And this is a little extended, but I need to read this. I want people to hear. And when I say I, realize that I'm talking about Tom Basso, not me. So in the spring of 2020, during the first parts of COVID's panic, the move in the market in the stocks was huge, and extremely huge moves in other markets. Many CTAs, that's a commodity trading advisor, and portfolio managers. I know people in my business that just stopped trading. They just went to cash. I did not, and we're about to find out you did not either. They felt the moves were insane and stocks looked like they were just melting down and they had to get safe. Okay? Tom, stayed with my strategies. I was hedged on my stock exposure. I was killing it in palladium futures and short energy contracts. These were huge moves that only come along once in a very long while. And I was in all of them watching my portfolio equity screaming upward. When appropriate, I peeled off partial winners, and even with this record-breaking volatility, I maintained my composure every day. Folks, this is the lesson that you have to learn for this. I ran unchanged my all-weather processes every single day through this record volatility. The stock hedge came off. I had a bunch of new buy signals, and the futures reversed. What was the result? I had the most profitable year of trading in my life at over 100%. And I'm not telling you this story to brag, since I didn't do anything special or anything different from what I do every boring day. That's just huge, Tom. How did you keep your composure during that? I had my best year ever. It was not 100%, but I wasn't long palladium and short energy. So, but regardless, sticking by the strategies.
Yeah, what ends up happening is when you realize that you've thought through the types of moves that can happen, both up, down, sideways, and you've prepared for them, then no matter what happens, it's kind of like you're doing the same thing, because you don't really care whether it's an up move or down move. You're not agonizing over, is the world coming to an end because the pandemic's going to wipe out humanity and everybody's going to die, and whatever they were trying to sell us then. And then on the other side of it, now we got the thing going the other way, and everybody's masking up, and we got a virus on the way, or a vaccine on the way, and it was overdone to the downside. So I think what ends up happening is you realize, you're just trying to keep on keeping on, because no matter which one it is, you just trading that day, and it all of a sudden simplifies your mind, and it takes all the stress away of trying to be right and try to predict what's going to happen, and
or to outguess all the hard work you've done. It takes that off the table and say, no, I'm not going to outguess. I've already done the work.
Yeah.
I don't want to repeat from our last interview, but at the very end of our first part one, you talked about this disassociative property of being able to look down on yourself and watching your life as a third party.
Yeah.
And I think
kind of watching the movie of Tom Basso.
Yeah, exactly.
And Tom happens to be the in every scene of the movie, strangely. Yeah. If you turn your whole life into the movie of you, and just watch the movie, it's very interesting taking that perspective, because you'll see the times when Tom seems happy and Tom seems stressed and Tom seems wondering what's going to happen next, and Tom is relating to his family or to his wife, or Tom is pruning the bush outside the yard, or Tom's cooking dinner, or Tom's drinking wine, or whatever Tom's doing. And I think that then all of a sudden you have the ability to see Tom trade and say, Tom's a little more stressed than makes any sense here. Why is he stressed? And well, he's stressed because he's trying to predict. And why is he predicting? Because you don't need to. And then you start getting this nice feedback loop that tells you, just be relaxed, just do your thing. You've already figured this out. You already know what you're going to do. It's not like you're going to be perfect. It's not like every trade's going to be profitable. But you have a plan, and you understand the risks of the plan and the benefits of the plan. So run the plan. And get it done as quick as possible, and then go off and golf someplace or whatever. Go
just
work
a
out.
Couple pages later in the book, you say this: when it comes to forecasting and predicting the future, well, we suck predicting what's coming up. There was a book that came out after Black Monday, folks, that's October 19th, 1987, that talked about two potential possibilities for the markets: a recession or a depression. What happened? Neither. Instead, the market went on a bull run for over a decade. Here's the really huge one. In 1989, Japan was the second largest economy in the world, primed to take over the U.S. as number one. Okay, now that's kind of hard to fathom, because Japan right now is the fourth largest economy behind China and Germany. But if in 1989 you would have told anyone that very shortly Japan would enter a 35-year bear market, you would have been laughed out of the room. But that's exactly what happened.
Yep. There's lots of
quit predicting.
Quit predicting.
Yeah.
It's stressful. It sets you up for a lot of angst, and you'll be wrong just as many times as you're right. You might as well flip a coin sometimes. So then you start realizing, just read what the market's doing and go with it. And don't worry, but don't second guess yourself. Don't second guess your strategies. Get good position sizing in place. That's extremely important in helping your mental state. And then deal with yourself. Watch the movie of your life.
Right. Yeah. And we talked about that in the first part. So if you guys did not hit the pause button and you're listening to this, you have to go back and listen to thoroughly the first part of the interview. So this next quote from you, 2 words, is, I think, very provocative. People say study success. Obviously, we're on this interview because I'm studying you as a successful trader and successful in many areas. But this headline says study failure. Study failure. Failure occurs often in our industry, the financial industry, yet the reasoning goes overlooked. Others assume that failure has occurred due to uneducated decisions or bad luck, but there were certainly strategies put into place before the failure occurred. There's a misconception that timing has everything to do with the success of your portfolio, or if some other variable is the most important one. It simply isn't true. Study failure. It will allow you to see a wider, more global approach. So tell us how you came to studying failure.
Yeah, what failure, because I had plenty of failures early on in trading, I simply looked at it as, okay, you lose some money. Why did you lose some money? Is there anything you would have done differently now that you know 100% 2020 foresight? But going back to when you had to make the decision to do it, is there anything that would change? Is there anything that you would do differently? Mm-hmm. And I kind of treated failure as the tuition at the College of Trading. And right. I was on my way to getting my degree. So you end up having to make some mistakes and end up paying your tuition a little bit to get those little pieces of wisdom into your brain so that you can go forward in a better fashion. And little by little, I got my degree.
Yeah.
With lots of failures.
School of Hard Knocks. And if you haven't listened to the first interview, remember that Tom, and he's open about this, 4 years of losing trading in future, but each year losing less. And look at how it turned out. A great ending. So I'm going to put graphic 9 up here, which is your complete trading strategy. Basically, you're saying, I've dealt with risk for half a century, exposing it, attacking it, and managing. We covered some of this in the first interview, but now that we've got the trading strategy on the screen, where we start with simulations, buy, sell, etc. I just want people to focus on this as they listen to your answer, on the difference between avoiding risk versus attacking and exposing it and managing it and using it to your advantage. Certainly the COVID-19 trading period would be a great example of how you did that.
Exactly. Attacking risk means that you're giving yourself sort of a weapon, if you want to say. You can become the aggressor as opposed to hoping that whatever defenses you've put in place are going to protect you. Instead, you're saying, I recognize that risk exists. I recognize there's bear markets out there. I recognize that 60% of the time the stock market goes in a sideways fashion. And when I recognize that is a possibility, I want to give myself tools to go after and exploit that potential situation or protect against it or whatever I'm trying to do. So in the case of my hedging, for instance, if I have long exposure due to stocks or ETFs, exchange-traded funds, and I know that indicators are starting to shift south and we're going into a bear move of some sort, Well, then I want to put a hedge on. So what is a hedge? In this case, for me, it's a short position in a Standard & Poor's 500 futures contract. And that will hedge my long-term portfolio. That's long only. It's to the upside. So in the bear market, it tries to start going down, but my hedge is the other way. It starts making money, and when the market goes up, it loses money. So the two are fighting each other and starting to go like this in my portfolio. So I'm just sitting there waltzing along, doing nothing. I'm happy as a clam. And I think that that's just one example of many of trying to attack the risk. I know there's going to be bear markets. Why not put some strategy in place to attack a bear market and try to exploit it to your advantage? Turn the risk around into a positive.
Right.
And I think if you start thinking through some of those things, there's lots of opportunities out there that, gosh, I've only got 9 strategies. I could probably invent another 10 or 20, but I don't want to spend all day sitting at my desk doing that. So as I can automate more, I will add more strategies. Lawrence Bensdorf, who's a good friend of mine over in Portugal, runs totally automated 50 strategies. And he swears that everyone adds some small value. I haven't analyzed that, but,
So when you say totally automated, part of the problem we have in the industry is that there's a limitation on software to be able to look at where, our buy-sell engine is, ratchet a stop up or down, depending on if you're long or short, and then transmit that into our online ordering system. You're saying he's got that actually in place?
Built it himself.
Wow. And it must be super proprietary then, or obviously...
It is. It's called QuantumX, and you typically go to his trading mastery school, and you become a student of the school, and along with the school and the training that goes with the school, you would end up get the software that QuantumX that he uses and teaches you how to use. Yeah. And it's pretty complicated. I have to say, when I look at it, it has very powerful, but it's not simple, intuitively obvious, cloud-based, point and click for the average person out there. It does require a little work, and I've looked at it, and I'm above average on probably computer programming and all that, and I've helped him with some suggestions. He's had me review some things in the software, but that's why I'm consulting now with a product called SimTrader that we hope to have out maybe the end of the year, so that it brings in data, allows people to play games with various indicators and do some historical simulations. But then more importantly to me, once you have that and you've figured out how you would like to deal with history, if you've done a good job there and you've position sized well in history and all that, you can turn this into every day you can send your orders into the broker type platform. So that's what we call a sim trader. It can do simulations and it can do trading for you.
Got it. And so there'll be some kind of API interface with Interactive Brokers or whoever people are using. Right?
Exactly. So Interactive will be the first broker that we'll use.
Yeah, and makes good sense.
I'm the alpha tester on the thing right now, and out of my 9 strategies, 6 of them are now fully automated and running every day successfully on SimTrader. So we still got to get that last 7th one. The last 2 are not going to be very automatable. It's like once a week, and I do it by hand. It's simple. So the 7 that I think could be automated will be done. And once we get there, then we're going to next phase is to get to beta testing.
Got it. As you finish the book, I love this last quote. And this makes the presumptions, folks, that you are going to become. Don't say if, say when. One last thing I want you to remember is to not gloat about your earnings to those who may not be traveling alongside you on the uphill path. In other words, profitable. A saying that I have on the wall next to me where I trade is, quote, unless you are humble in the face of the market will see to it that you are humbled. Don't we know that? This isn't a competition. It's a long-term puzzle we are all trying to solve. if you are getting closer to that, be kind to those who might be a few steps behind you.
Right. The reason
That's
for
just,
the book.
yeah, exactly. So
Trying to output. I didn't have an all-weather trader book to read back in the 70s when I tried to take all this on. So it's at my stage of life, I'm comfortable. Two beautiful houses, one under remodel. It doesn't look so beautiful these days, but it will in about 6 months.
that's
And
awesome.
I've got two beautiful screens to help me with my declining aged vision that I have these days. And I'm on a golf course. I mean, my life's a dream. And
Beautiful wife. I mean, let's just throw that in there. Who's a
oh,
musician? It's hard to
which,
beat a
and
beautiful woman who's a musician, Tom.
she does send her hi, but
Oh,
she
good.
she misses out on being able to see you in Nashville, and
Well,
hopes you have a good time in Chicago.
thank you. We are glad to be back with family and kids and grandkids, which again is all part of the stress relief and making life pleasurable. So,
But in the end, try to realize that and take pleasure in all those little things in life, the family and the joy of, my wife and I just finished up singing in 3 charity concerts, and we danced solo on stage in front of hundreds of people to one of
wow.
the Four Seasons Jersey Boys songs, and we nailed the endings all 3 times, and the crowd went crazy, and it's a lot of fun. And that has nothing to do with trading, but it has everything to do with life and enjoying life. And I think that you have to be humble and say to yourself, I thank goodness that I made the decisions I did, and I worked hard when I worked hard, and I'm reaping some of the benefits from it. But I was trying to, with the book, give people starting out in the business a little bit of a roadmap and kind of go through some of the things that I learned and how I learned them, and tell some stories, and hopefully it meant something to the people reading the book that, okay, I can see why Tom would come to this conclusion and add this feature to his trading. That makes sense. And they don't have to go through the same mistakes or trouble that I had to go through to
Exactly,
learn.
because you've done it.
I've already done it, and you might as well get the benefit of that. And then hopefully you write a book 20, 30 years from now, The All-Weather Trader 2, and update it, and go way beyond what Tom did.
Folks, if you want to experience the Lewis and Clark Trail, you're not around to go with them when they do it, but have the benefit of following behind them, and you'll still have the joy of exploration. That's what Tom Basso has brought to us all. Whether you trade for yourself, invest for yourself or friends, or you have clients, you still need to be mentally, emotionally prepared with a strategy. And if you're just managing, I should say this way, if you have someone managing your money, you now have a way, just from this book alone, to hold your money manager to a higher degree of accountability, because you now know, when you finish the book and finish watching these 2 interviews, way more than you did, I'm certain, than when you started. And an educated consumer is a better consumer. Don't you think, Tom?
And as a money manager, I wish everybody had read this book and asked me tough questions and pushed me to be a better money manager. I found that as a money manager, my clients were not up to the task of being good clients. It's a two-way kind of thing. I can be the best money manager I can be, but if you're not a good client, then the relationship's not going to be good over the long run. And I found that happened more often than I'd like. And one of the reasons why I'm very happy to just be managing my own money now instead of client money. But
yeah, no, I hear you on that. I think it's great that traders like ourselves can keep each other sharp by asking these questions. I mean, I read the book, I'm sure, to a greater detail than I would normally have, because I knew I was interviewing you, and it's benefited our audience. Tom, thank you so much for both these interviews. Wishing you continued success. I have a feeling we will meet again in the pixels of life, and we'll have a big event that comes up and brings the all-weather approach into the highlight, and we'll want to talk about it to continue to encourage people not to fall down when crazy markets happen. I mean, as we sit here right now, there was a meeting planned with McCarthy and Biden, Speaker of the House and the President, and they've called it off. We're going to run out of money in 2 weeks. What does that matter? I don't know, but you and I are going to be back here in 2 weeks. But this is a big deal, okay? If we don't pay our debt, if we default, it's a lot tougher to default the first time. Pardon me. Yeah, tougher to default the first time than the second or third or the fourth or fifth. And then by the third or fourth, we become Venezuela.
Right. And
so
remember that back in the 70s, I was interviewed for a television show out in L.A., and I made the statement, even T-bills have risk. And they said, how do T-bills have risk? And I said, well, what if Congress and the president, whatever, decide to default on the debt?
In the 70s, you said that, half a century ago.
In the 70s. And I said, or it might have been early 80s, actually. And I said, well, it's just take a decision of Congress to stop making the payments and you default on the debt.
And it's literally that simple. And a Congress that becomes obstinate.
Here we are, let's see, 80, so it'd be about 43 years later or something after I said that, and we're talking about defaulting on the debt. And there's risk with everything. The point is to try to find the risk and attack it, and then you're in command a little bit. You at least have a plan. It's a lot less stressful, and you're way ahead of everybody else.
Folks, get the book. Tell your friends to get the book. Watch my channel, watch Tom's channel for following interviews. The market is going to be there every single day, and we're going to be there to cover it, continue to encourage you to be an all-weather trader. God bless you, Tom and Brenda.
Thanks,
and family.
Charles.
And we will see you next time.
Oh, it was great. Thanks.